What in God's name was the Fed and some of your other agencies thinking when you allowed banks to debank customers for reputational risk? Are you kidding me? Why did you allow that to happen? Because you didn't like...
We'll start our questions this morning with Senator Kennedy.
Thank you, Mr. Chairman, for that courtesy. Madam Vice Chair, credit should be given when it is due. I remember, well, 3 or 4 years ago, Chairman Powell and others were giving a report on the economy. Inflation was 9%. Was gutting the American people like a fish. Stevie Wonder could have seen it coming. President Biden asked, and Congress consented, I didn't, that we start spending money like it had the value of Louisiana ditch water. Had President Biden, had we discovered life on Mars when President Biden was president, he would have sent it money, immediately. And I remember the Federal Reserve represented by Chairman Powell sitting here, and we're talking about what to do about it. And he explained his plans, and in so many words, I said, not going to work. I've read the white papers. You can get inflation down, but we're going to have to suffer unemployment of 7, 8, 9%. It didn't happen, did it? We had a soft landing. And the Federal Reserve was in part responsible, in the best sense of the word, for that. And we don't applaud that enough. And we can debate whether the chairman and the vice chairman and others should raise or lower interest rates, and what we should do about quantitative easing and how many economists can dance on the head of the pin. But it's a fact. We had a soft landing. Thank God for it. Now, inflation is not down where we want, but 2.7% is a hell of a lot better than 9% without having to suffer 7, 8, 9, 10% unemployment and the human misery that goes with it. So the Fed did something right. On the other hand, what in God's name was the Fed and some of your other agencies thinking when you allowed banks to debank customers for reputational risk? Are you kidding me? Why did you allow that to happen? Because you didn't like their politics, or you didn't like the products they made. I mean, do you think it would be fair? Senator Warren's not here, so I hesitate to talk about it. Senator Warren was a distinguished professor at Harvard University. Some people don't like Harvard. Some people don't like their politics. How could you possibly allow a bank to have the option? I'm not saying they did it, but to debank someone like Senator Warren, I'm using her as a hypothetical example, because you didn't like her politics. And you can say the same thing about gun manufacturers and oil and gas and anybody you don't like, and you let the banks do it. What in God's name were y'all thinking, Madam Vice Chair?
Well, Senator, I appreciate your concerns, and I share them. I was not the vice chair at the time
I know that.
Decisions were made.
But your institution went along with it. The banks proposed it, and your institution sucked it up like a Hoover Deluxe.
In my view, debanking is never an appropriate activity. It is, every American in this country should have access to financial services, and they should not be limited from access to those services based on their political, religious beliefs, or their engagement in a particular business that may be disfavored but is legally
Let me tell you, folks, this isn't over yet. Thank you, Mr. Chair.
To a time when inflation had surged to a time when inflation had surged to 9%, when, in his words, it was gutting the American people like a fish. He reminded the room that many had predicted catastrophe, that tightening monetary policy would crush the labor market, that unemployment would soar to 7, 8, even 10%. But it didn't. The Federal Reserve engineered what economists call a soft landing. Inflation falling from 9% to 2.7% without mass job losses. Kennedy gave credit where he believed it was due. He acknowledged that the Fed, led by Chairman Powell and supported by its vice chair, had navigated an economic storm that many feared would spiral out of control. It was a rare moment of bipartisan recognition. A conservative senator praising an institution often criticized by his own party. A reminder that, at its best, American governance can work. That technocratic expertise and steady leadership can prevent deeper economic pain. And then, the pivot. What in God's name, he asked, his voice tightening, was the Fed thinking when you allowed banks to debank customers for reputational risk? The room grew heavier, because this was no longer about interest rates, no longer about white papers or projections. It was about power, access, the quiet authority to decide who participates in the modern economy and who does not. When Kennedy said, "Are you kidding me?" he wasn't challenging a decimal point. He was challenging a philosophy. The allegation at the center of his questioning was stark, that financial institutions under regulatory oversight had restricted services to individuals or businesses not because they had violated the law, but because they were politically disfavored, because their industry, their beliefs, or their associations were deemed controversial. He invoked a hypothetical, Senator Elizabeth Warren, a former Harvard professor. What if a bank decided it didn't like her politics? Would it be acceptable to cut her off from financial services, to close accounts, to deny access to capital? He extended that logic to gun manufacturers, to oil and gas companies, to any lawful enterprise that might fall out of favor with regulators or corporate boards. The vice chair responded carefully. She said debanking is never appropriate. She affirmed that every American should have access to financial services, regardless of political or religious beliefs, as long as their activity is legal. But Kennedy pressed harder. He wasn't asking about policy statements. He was asking about what happened. Because in a nation built on equal protection under the law, financial access is not a luxury. It is oxygen. Without it, businesses wither. Individuals are sidelined. Participation in the economic system becomes conditional, not on legality, but on acceptability. And that is where the deeper tension lies. The Federal Reserve is designed to be independent, shielded from electoral politics, guided by data and economic models. That independence is meant to protect the country from short-term political pressures. It is meant to safeguard stability, but independence without accountability can drift into insulation. Kennedy's confrontation revealed a broader anxiety, that regulatory bodies, even unintentionally, can shape the contours of public life in ways voters never explicitly endorsed. That behind closed doors, in guidance memos and supervisory conversations, decisions can ripple outward, affecting who thrives and who struggles. The hearing illuminated two Americas in conversation with each other. One America, grateful that inflation has eased, that unemployment did not spike, that the feared recession did not fully materialize. An America that values steady hands at the helm of monetary policy. And another America wary that financial institutions might become gatekeepers of ideology. That access to banking, once a neutral utility, could become entangled with cultural or political disputes. The tension between those realities is not simple. It is not partisan theater alone. It is a question of boundaries. How far should regulators go in shaping the behavior of private banks? When does risk management become viewpoint discrimination? When does caution become coercion? Kennedy's rhetorical fire may have been sharp, even theatrical at times, but beneath it lay a constitutional instinct that the system must treat lawful actors equally. That disagreement with someone's politics cannot become grounds for exclusion from the financial mainstream. And the vice chair's response? acknowledging the principle that access should not hinge on belief, underscored another truth. Institutions, too, are grappling with where those lines should be drawn. This exchange was not just about past decisions, it was about precedent. If reputational risk becomes a justification for exclusion, who defines reputation? Regulators, activists, corporate boards, public opinion? In a free society, those questions matter deeply. Because the American system rests on a fragile balance, markets guided by law, not ideology, institutions accountable to democratic oversight, and citizens able to engage in lawful enterprise without fear that political wins will determine their economic survival. As the gavel moved the hearing forward, Kennedy closed with a warning: this isn't over yet. And perhaps that is the most telling line of all. The debate over inflation may have cooled. The immediate crisis may have passed, but the argument over who holds power and how that power is exercised continues. In that committee room, beneath the formalities and procedural courtesies, something larger was on display: a struggle to define fairness in an era of polarized politics. A reminder that economic policy is never just about numbers. It is about people, about trust, about whether the institutions designed to stabilize the system remain anchored in equal treatment. The health of a republic is measured not only by growth rates or inflation targets, but by whether its citizens believe the rules apply evenly. And that belief must be earned again and again. If you believe in holding power accountable, if you believe in shining light on the decisions that shape our nation's future, then stay with us. Subscribe to Liberty Report USA. Support our work to expose the truth.